Today's video is sponsored by The Daily Upside. They're a completely free daily newsletter. More on this later in the video.
The Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point.
Jerome Powell has finally done it. The Federal Reserve just announced its first rate cut, pivoting its monetary policy from the tightening, restrictive stance we've seen over the past 2 years to a cycle of rate cuts, easing monetary policy and stimulating the economy. Pop the champagne, it's time to celebrate. Or is it? Since 1990, there have been 4 official US recessions, and each of them came shortly after the Fed began cutting interest rates. That certainly doesn't sound very good, except there's been 8 rate cut cycles during that period. Only 4 of them were followed by a recession. That's because there isn't just one reason why the Federal Reserve cuts interest rates. In fact, there's 4 reasons. So to understand what might happen to the stock market or the economy in the current rate cut cycle, we need to understand the circumstances that surrounded the previous ones. Let me take you back to June 1990. Inflation was 4.7%, which is high. It sits well outside the generally agreed 2 to 3% healthy range, but it had been coming down. The unemployment rate was steady at around 5.5%, and the US was not in recession. So then why did the Fed start cutting rates? The central bank started shifting its monetary policy in response to the 1990 oil price shock. Iraq invaded one of the OPEC countries called Kuwait, causing oil to spike from $17 in July 1990 to $39 by September that year. So the Fed cut interest rates from 8.25% in July 1990 to 3% in September of 1992, a total of 525 basis points over 2 years. Even though it wasn't known at the time, a recession started the same month that the rate cuts began, lasting until March of 1991. The unemployment rate rose significantly, and inflation fell. If you had invested in the stock market when the Fed started cutting rates, you would have experienced a 15% decline within the first 6 months, followed by a sharp recovery, and 1 year later, you would have been up almost 9%. This is what I'll call a type 1 circumstance for interest rate cuts, when the Federal Reserve cuts interest rates as a reaction to a recession-causing economic event. This is the most common type of rate cut cycle of the past 30 years. 4 of the 8 cutting cycles are type 1. In 2001, for example, the Fed rate cuts came in response to the bursting of the internet stock market bubble. The stock market peaked in early 2000 and fell 12% before the Fed stepped in and began cutting in January of 2001. They cut a total of 475 basis points throughout 2001 as the dot-com bubble continued to unravel and after the September 11 terrorist attacks. You'll notice that the Fed rate cuts started a few months before the actual recession, and the same was true in 2007. The Fed started that rate cut cycle in September of 2007, 3 months before the recession started. But while these rate cuts came before the actual recession period, they were still made in reaction to an economic shock. In 1990, it was the oil crisis. In 2001, it was the tech bubble bursting, and in 2007, it was in response to the housing bubble beginning to pop. And in the last type 1 circumstance, it was a reaction to the spread of COVID-19 and the collapse of the stock market. Without additional context, it looks like the Fed cuts rates and shortly after a recession begins. But in all of these circumstances, there was already a widespread economic event taking place. The Fed rate cut today is not in response to one of these events, so we're not a type 1 rate cut scenario. That's certainly not to say that it can't turn into one very quickly, but at least as of today, there are much better examples from the past of rate cut cycles that better match what we're seeing in 2024 and gives us a better window into what to expect for the stock market and the economy from here. A quick pause in the video. I just want to share with you an incredible free resource for staying up to date with the business world. The sponsor of today's video, The Daily Upside. They're a completely free daily newsletter with over 1 million investors subscribed, including myself. It's really easy to sign up, and with just 5 minutes each morning, you'll be able able to get up to speed on the top finance and investing news, including insights, analysis, and clarity on the top business stories circling the globe. I've been a long time and avid reader of their newsletter, not only because it helps me to stay up to date, but they always have unique details in stories that I don't find in traditional media, such as the fact that derivatives traders are now pricing in 250 basis points of rate cuts by the end of the year, which would likely only happen if the Fed was reacting to a recession. Again, it's completely free to sign up, and you'll receive one information-filled email each morning. Join over 1 million people who trust the daily upside. Sign up using the link in the description. While the Type 1 rate cut cycles get talked about the most, I think the Type 2 category is far more interesting. There's only been one of them in 35 years, and it happened in 1998. At the time, the economy was in great shape. Inflation was extremely low and falling, the unemployment rate was just 4.5% and also falling, and the US was not in a recession. But just like the rate cut cycles we've spoken about, the Fed in this case was also reacting to an economic event. Beginning in 1997, Thailand was facing a currency crisis. They were burdened with a huge amount of foreign debt and couldn't make payments because their currency was pegged to the US dollar. After being forced to unpeg their currency, it collapsed, and the pain spread to other Southeast Asian countries and then to Japan and South Korea as their currencies collapsed too. The spread of crippling economies across Asia also slowed the demand for oil, contributing to its price falling sharply. While all of this was happening outside of the US, American markets were affected. The S&P falling 14% from a peak in April 1998 to July. In September and until November, the Fed cut interest rates by 75 basis points. So far, it sounds like this fits within the Type 1 category, but what makes this one different is that there was no US recession that followed. It's less common, but even if the Fed is cutting rates in response to an economic event, it doesn't always lead to a recession. But again, there is no economic event or shock that the Fed is reacting to in 2024, so today's rate cuts are also not like 1998. Today's rate cuts are much more similar to Type 3 and Type 4 cycles. There have been two Type 3 rate cut cycles since 1990. The first was in 2002. The US was now out of its 2001 recession, and unemployment had stopped rising, settling below 6%. The economy was recovering, but the Fed felt that the progress was too slow. Inflation in particular was a concern. It sat around 2%, but there was concern it could continue to decline and turn into deflation. Lower prices might sound pretty good, but it can quickly turn into a very vicious downward spiral that can be very, very hard to get out of. So starting in November 2002, the Fed cut rates for a total of 75 basis points. This turned out to be the bottom of the stock market, with the S&P 500 rising 13% in the year after the first cut. And the economy continued its recovery. No recession after the rate cutting cycle. 2002 and also 2019 fall into Type 3. Minor policy adjustments due to economic weakness. Rather than responding to a large economic shock, it's the Fed seeing inflation falling too much and unemployment staying too high, so they make a small change to rates. You could make a good argument that the rate cuts we're seeing today fits into this category. Today's cuts also fit into the Type 4 category, which is my favorite, so I've saved it to last, but we'll get to that in a minute. Today's economy, by the headline figures, is in great condition, but it's potentially weakening. Prices on average are 23% higher than pre-COVID, and for a lot of items, it's much worse. The annual inflation rate now is just 2.6%. That's in the healthy 2 to 3% range, but it has been falling quickly, and it's possible the Fed is concerned about letting us fall into deflation, much like their concerns in 2002. The unemployment rate is also very good, 4.2%, but since 2023, it has been rising as businesses contend with supply-side inflation. But as I mentioned earlier, today's environment looks a lot like the Type 4 rate cut scenario. It's only happened once in the last 30 years, and it gets so little attention that you probably didn't even know it occurred. This rate cut cycle happened in 1995. Inflation was around 3%, the unemployment rate was falling but still a little high in the mid 5%, but for the most part, conditions were pretty good. So why did the Fed cut interest rates by a total of 75 basis points? points. Well, this is what the Fed likes to call a mid-cycle adjustment. In their July 1995 meeting, they said, as a result of monetary tightening initiated in early 1994, inflationary pressures have receded enough to accommodate a modest adjustment in monetary conditions. In the early 90s, the US was experiencing an economic boom, and sometimes when this is the case, the Fed likes to raise interest rates. They do this to prevent the economy from getting too hot and creating high inflation, but also because the higher the interest rates are when an economic shock hits, the more room they have to lower them and stimulate the economy. After a short stint of rate increases, the Fed made some minor rate cuts again to keep the economy in balance. This is another example of a Fed rate hike and cutting cycle that didn't lead to a recession, something you might have heard called a soft landing. This 1995 soft landing is what the Fed is hoping to achieve in 2024. They raised interest rates aggressively to combat inflation and successfully brought it back into a healthy range. So it's appropriate for them to now ease monetary policy and pray that they've nailed the policy adjustments. I'm going to talk about how the stock market has performed in the short term and long term after each of these rate cut cycles in a minute, but this is a good spot in the video, I think, to state the obvious, which is there's no way anybody can know if there's going to be a recession, say, next year. It's possible, of course, but hopefully by going through some of the past rate cut cycles, we can see there are a variety of possible outcomes, some good and some bad. Okay, let's take a look at stock market returns. So there's been 8 rate cut cycles since 1990. On average, the 1-year performance from the first cut in each cycle has been 11.8%. So on average, it's paid to be invested during the cutting cycle. But there have been a wide array of results, spanning from negative 24% in 2007 to plus 54% in 2020. Who would have guessed it? Short-term returns vary a lot. But what about long-term returns? Well, if you bought stock when the Fed first cut rates in each cycle, on average, your return would have been 5.03% per year for the next 10 years. Oddly, that's actually not that good, but again, it's because there's a wide variety of outcomes. The best 10-year period came after the 1990 cut. You would have earned a 14.9% per year return. The worst was 1998. Your 10-year return was negative 2.58% per year. If you bought stock in 1998, even 10 years later, you would have been down, but held on to today, and you've done extremely well. Which I think is a nice reminder that the stock market is great, but it is a long-term wealth vehicle. Subscribe if you enjoyed the video, and consider checking out one of these videos next.